Hey guys, I just wanted to jump in for a second and let you know a little bit about today's live stream sponsor, DNA Funded. DNA Funded has very generous profit sharing up to 90% and 3 different unique challenge types. For those looking to get funded, they also have speedy payouts, unlimited trading days on the first and second phase of their challenges, a very wide list of different things you can trade with over 800 different assets tradable, and maybe the most important component, a very experienced team behind the whole operation. So if you're interested in learning more about DNA Funded, click the link, check it out, see if it's right for you, and make sure to do your own due diligence to see if what they have to offer fits your trading style. For 20% off, you can use code A1T20. Again, that will be 20% off any of their challenges you'd like to check out. Thank you again to DNA Funded for sponsoring today's live stream. Now back to the show. Good morning, everyone. Welcome back to another live stream and the main event of the week. Today we have the Jackson Hole Symposium speech from Jerome Powell, which is expected to be potentially market moving. We'll see what happens with it. There is, I actually had an interesting chart come across my screen here this morning from Marco, who will be joining the live stream actually later. We'll probably talk a little bit about what is happening, but Marco from our team here put together the outcome expectations from Jerome Powell's Jackson Hole speech. I thought this was interesting. A lot of people are expecting neutrality or a boring speech from Jerome Powell. The other majority or close to majority perspective would be that if he does have a lean, it is likely to be hawkish, which if you've been listening to my videos, I've kind of felt that way as well. From my analysis, I think there's a good chance that Powell could come across as a bit more hawkish than usual. And then you have some possibility of dovishness as well, with the the very unlikely outliers of extremely hawkish or extremely dovish. I've gotten all sorts of different responses and comments, people saying he's definitely going to cut rates. He's definitely not going to cut rates. He'll never cut rates. I've got all these different opinions floating around. But let's see, because here's the thing. I think that this is probably where we see Powell. I think you're probably going to get somewhere in between these two. Specifically, what do I mean by this? Well, I think that Powell is going to probably signal that the Fed will possibly see it as reasonable to cut this year, maybe one time. I think the market is thinking we're going to get 2, maybe 3 rate cuts this year. That's been kind of the whisper number. But there is a possibility that you get the hawkish lean today from Powell, and we lean more towards 1 to maybe none this year. If that were to be the case, or for the rest of this year, right? If that were to be the case, how would the market react? Well, it would likely be ugly. It would not be very popular. A lot of stocks, especially like the housing market, right? Very locked up. You've got a gridlocked housing world. Nobody can buy, nobody can sell, because interest rates, they're not necessarily historically high at all, but in recent history, they are high. And so the housing market feels kind of gridlocked. And so there's a lot of Americans who really want rate cuts. What does it do to the market? Well, to be completely honest, it doesn't do a whole lot to companies like Google and Nvidia and Apple, who have so much money that they don't need to borrow it, but it does impact smaller companies. It impacts the consumer. It impacts the housing world. So it does matter. Rate cuts do matter. But so does inflation. People are worried about inflation. The Fed seems to be, based on their meeting minutes this week, seem to lean a little bit more on the cautionary tale of inflation than jobs data. So that's where I think you get the idea of hawkishness. Is like we're worried about inflation more than we're worried about housing. Jobs, right? They seem to be worried a little bit more about inflation right now than the jobs market. And so that's where I think you fall into this camp of getting some potential surprisingly hawkish sounding stuff from Jerome Powell. By the way, if you're not in our Discord channel, we have a free version available. You can join the Discord. We'll drop the link here in the chat to fill out the form if you want to get access to our Discord server. 500K. Yes, indeed. We hit 500K on the channel. That is absolutely crazy. I'm good. Good to see everybody in the chat. Thank you for being here. Big day today, potentially market moving. I do want to remind you that these sorts of events can be very, very volatile, or they can be a nothing burger. Like, it is possible that you just get, kind of a back and forth. But the bigger question becomes, do you have something said that changes the course of rate expectations for this year? Ultimately, we probably want to keep an eye on the yields world, right? The 2-year government bond yield is a great way to generally get an idea of what the market, the bond market specifically, thinks the Fed is likely to do next. It's been gradually trending lower this year, so expectations for rate cuts have been rising. However, Powell has been a little bit more on the hawkish side this year as well. You have a situation in which inflation is still there. I mean, this is a fascinating topic here to me. So, if you look at the CPI, right, the consumer price index, the consumer price index is rising a little bit. Prices are going up, but they're not going up as much as analyst forecasts have been, right? So the red dot that you see on your screen, those are historical forecasts, like Wall Street forecasts. And you can see that the number, the actual blue bar, has been less than expected the last several reported times for CPI. So we've had some, arguably, a rise in inflation, yes, but it's much less than people thought it would be. But this is the consumer prices. We can also look at the producer prices. And this is really important that we make this distinction. Producer prices, these are the prices that are seen before the consumer sees them, right? So when you go to the store, before you ever buy something out of the store, there's a whole list of, buying and selling and supply chain stuff that goes on before, it gets to you at the store. So what's interesting here is we can kind of see something different happening in the producer price index. You saw a big spike year over year on the producer price index, expected to be 2.5%. It came in at 3.3%. So what this is telling us, or at least suggesting, is that wholesale importers, exporters, etc., currently are eating some of the cost. So tariffs, the trade dynamic stuff, has increased the cost of doing business. That's just factual, right? If you add in a tax to goods coming into the States, there is an increase in prices that has to happen. But what we're seeing is that the producers, right, are eating the cost right now. They're not necessarily passing it fully to the consumer just yet. Now, why does this matter? Well, if the Fed today, if Powell sort of continues to reiterate that, things like producer price index are suggesting we do have inflation coming down the system, it's just not yet in the consumer price index. It's largely expected that wholesale producers, businesses, they pass on cost to consumers. Shareholders do not want their companies to just take profit margin hits. They'll pass those prices on to the consumer. So we're looking at inflation. We're saying, okay, we do have a potential inflationary pressure in the form of tariffs, right? And so that is something we do need to consider. So the Fed may say, we still have inflation to deal with. So that's where I think you may get a hawkish Powell. However, here's where things get tricky. Look at the NFP reports. Jobs data has been coming in weaker over time. Take a look at job openings in the United States. They are trending lower. What about unemployment? Unemployment rate holding up steady. Not so bad here. 4.2% unemployment rate is historically pretty dang good. So you put all this together, though, and you have a story here where you have jobs data that's sort of showing signs of softening, but you also have inflation that doesn't seem to want to go away, and there is a persistent pressure there with tariffs. So what do you do with this? What do you as a trader? Now we've done the macro. That's the big picture. What do you do with that as a trader? Well, you say the Fed may not, they may want to cut a little bit, and that might be what they can get away with this year, is maybe they, because the Fed wants to cut rates. It is, the Fed has an interest in cutting interest rates. It's just they don't want to cut interest rates if it means inflation spirals up too. So what do you do? What do you do if you're the Fed? That's a challenging circumstance. That is why, in my personal opinion, one of the easier things out there, I don't like to short indices. I've talked about that as a really hard trade. Stocks go up over time, not all the time, not every day, not every month, not every year, but over time they go up. So it's a hard trade to short the indices. However, raising cash and being defensive is a position in markets. And so for me, I have been doing so. I've been selling calls, which has worked really well because the market's been going down. So I've sold calls against a lot of the stocks that I own. And I also have been raising cash in my portfolio for bigger drops that I think could be ahead. I think that what we have here is it's a rock and a hard place. You got jobs data struggling. You've got at the same time inflation sticky. I think the market is wanting rate cuts. And you know what's eerily familiar here? This is what happened back in 2018, 2019. Like to a T. People thought the Fed was going to cut rates, and the Fed signaled they took the punch away from the party pretty much. And it led to a pretty big sell-off into year end, right? Was this 2018 or 2019? I think I'm getting this mixed up. No, it was like right into 2019. I'm pretty sure. Like right around Christmas time, we had the massive fall off. We had trade. I mean, literally during this time, some of the same stuff was going on. Trump was imposing tariffs. He was doing a trade war with China, and the Fed was expected to cut rates, and they didn't. I mean, we may be seeing literally a rinse and repeat of what happened. It would be like eerily familiar. So anyways, I think that Powell's going to be hawkish. I could be wrong. If I am wrong, I still own a bunch of stocks. I just have covered calls on a lot of them. So if the stock market rips through the highs, I will have some gains to be made, but I will cap my upside with those calls that I've sold. Essentially, the main goal here for me is to be defensive in this market. I don't have enough conviction to be like, okay, the macro does not look good enough for me to be like stocks are a huge buy, right? The stock market impact here on the Edgefinder's economic heat map is quite negative. What that means is inflation has been detected as hot on the Edgefinder, and economic data has been expected or has been seen as cooler than expected by the Edgefinder. That combination is not an environment where I can be heavy long stocks. Now, it is an environment, however, where gold and alternatives look more attractive to me right now. The stock market has had a really good run. Doesn't mean it can't keep going. It could. I could be dead wrong about this. I'm just a guy on the internet. Don't take any sort of financial advice from me because that's not what this channel is for. This is me sharing insights. Sometimes I'm right. Sometimes I'm wrong. When it comes to this dynamic, though, I can't justify being like, okay, yeah, this is a huge buy for me. Stocks at all-time highs with inflation sticky and jobs data weakening. That dynamic to me, I think will take a toll on stocks at some point here. Again, I'm not short the market. I have no interest in shorting the market. I'm just keeping some cash on the sidelines and waiting for dips. At the same time, when we take a look at gold, I like it. Technicals, I've said this many times in the shows recently, technicals don't look great. They're just choppy right now. If we got some momentum here forming or a bigger pullback, right? A pullback to this area here, a break or retest, both of these scenarios look like trades that I actually really like. But where we are, we're just in no man's land in the middle of the range. I don't have anything to do with gold. I do like it, however, bullish. So what the Edgefinder does is it automatically looks at all this data points that we just got done discussing. We just broke down inflation. We broke down jobs data. The Edgefinder automates that. It is essentially a macro fundamental automation tool. And what it does, it looks at job openings. It looks at ADP, non-farm payroll, CPI, PPI, PCE, retail sales, all of these factors. And it automatically generates bias, right? So if we look at like top setups within the Edgefinder right now, gold and silver are getting strong readings, mostly because of the dynamic that we just got done discussing. If the Fed is dealing with potentially some form of stagflation, right? If you're talking about a situation in which the Fed has inflation in front of it and weakening jobs data, gold starts to look pretty attractive to me. Now, gold is in super consolidation mode. It is just super boring. It's not gone anywhere. Nobody's looking at it. And yet, again, I think that the fundamental factors here, the macro scenario, favors it. So I like gold and I like silver quite a bit as possible hideout spots. Oil's also getting a bearish reading within the edge finder off of some of those weak economic reads. You may see, less rate cuts and slowing jobs data, slowing demand for oil prices. Oil for me, again, never financial advice, but I like the idea of possible shorts on oil. If we get a pushback up into this past level of support turn resistance, I think you may have another leg lower for oil prices coming. So I'm just really on the cautious side going into this. And again, if there is a surprisingly dovish Powell, if he says, we do see a need to cut rates a few times, we're going to keep watching the inflation data. If he changes to more of a wait and see type, more of a, let's go ahead and do some cuts kind of vibe, if that is what we hear from Powell today, the market will absolutely rip because the market kind of expects him actually to be a little bit of a Debbie Downer on the rate cut story, because he's been kind of, the hawk of the group, if you will. He's been saying we're not going to cut rates. We're not, or he's not been saying we're not going to cut rates, but he's not signaled rate cuts yet. Now, what the doves in the room, people who think he's going to be dovish, would say is that this is typically, Jackson Hole is usually a speech. It's a big event where Fed officials have historically made kind of their next move. And so again, going back to like 2018, that is where Powell actually took the stand and people expected him to be more dovish, and he was very hawkish, and the markets really, really did not like it. So could we literally get a repeat event where you have this market, which is, hyped up? Look, I don't think, if you're talking about like Amazon, if you're looking at like Apple, if you're looking at Nvidia, those companies don't need rate cuts. But there is a significant amount of the economy that does really want rate cuts. The housing world, I mentioned this earlier, completely locked up. People can't buy, people can't sell, because again, refinancing is you can go look at, like, house prices have been actually gradually coming down in the last few years because there's just such a lack of demand for it. It's a really interesting dynamic. So, you have rates sort of stuck where they are. They've not really moved in either direction. You had last year, rate cuts were expected big time, and then we had another bout with inflation, and rates went right back up. And so now that's what put the Fed on hold. And so you don't really see this drastic move lower in yields, which would suggest you're going to get rate cuts. So that's where I think the market's kind of like, yeah, we might just get kind of a prolonged waiting period where the Fed kind of just has to wait and sit in their, discomfort, if you will. So we'll see. I mean, again, I am not short the market. I am interested in gold longs. Silver longs also look attractive. If you get a swing back down to like 36.50, I think that could look like a good trade for me that I'm going to watch. Take a look at oil. I mentioned earlier, a bounce in oil further from here might be a possible short setup for me. Also, just a quick plug, we did drop this week a free version of the Edge Finder available now on our website. If you'd like to try out the Edge Finder and all of its features, it is a limited version, but if you want to explore what the Edge Finder has to offer, check this out. We're going to drop a link here in the chat if you are here and would like to explore our tools. Again, fundamental analysis sounds like hocus pocus and magic and spells and all these different formulas when you don't have the right tools to track them. But when you actually have something that combines the labor statistics data and inflation stats, puts it in front of you, and also does the heavy lifting of interpreting whether it's bullish or bearish for things, fundamentals can easily be a part of your process by the end of today. If you want to try out the Edge Finder, click this link that's just been dropped in the chat. You can get access now to our free demo version. If you guys don't mind dropping the link one more time here, you can just fill out that form and it will automatically email you access to the Edge Finder free demo version. Now, I do want to just reiterate, the Edge Finder free demo version is not a substitute for buying our products. To be completely honest, this product is very expensive to build and maintain. We have a team of people that are dedicated behind the scenes to building this stuff. It's not free to build this stuff, but we do offer, because people have asked, a free opportunity to explore the tool with a limited feature base so that you can just see what it's about. And maybe in the future, if you like it, if you're like, hey, that thing's pretty cool, you consider purchasing it. So there's your chance to do so. Click this link right here, fill that form out, takes like 2 seconds, and we will send you the Edge Finder free demo version. So what are we looking at? We have got here about 37 minutes before we hear from the big man. What's going to happen in terms of market volatility? Well, the market itself, the VIX has been real quiet here recently. I'm actually just curious. Maybe we can do a quick, I'm not going to do it. I was going to say we could pull up some implied volatility stuff on the options market, but I don't want to, that will take too long and it will step away from the stream purpose. But basically, there is likely to be some volatility here today. It's not certain because sometimes you get kind of like a nothing. I actually think that if Powell holds his cards too close to his chest and does not give us a signal of any leniency towards rate cuts, the markets would not like that. Here's why. Powell has already kind of been on the camp of like, we're going to wait and see. You know, we are still seeing inflation problems. He's mentioned that the tariff stuff concerns him and his team, that they're, you know, going to see inflation. That's been his narrative. People who are wanting rate cuts, this is kind of the chance in August. You're not going to hear, we don't have another Fed meeting in August. This is it. This is the point at which if Powell is going to signal some dovishness ahead of when we hear from him on September 17th, the Fed day, this would be it. So in my mind, if you get a Powell who's like holding his cards like this, and he's not going to say a word about what he's going to do with rates, there's very much the possibility that the market just kind of does not like that, because it's pretty likely that it's pretty unlikely that you're going to get rate cuts with multiple to follow if you don't hear something dovish from Powell today. I think what's interesting too, guys, is that you can watch the Fed Watch tool. I mean, the way to do this is just keep an eye on the 10-year. You don't even need to use anything else. Just look at the 10-year yield. It's going to suggest what people are feeling about the market. So I can tell you right now, probabilities for rate cuts have been diminishing based on what the 10-year yield has been doing. It's been going up. Let me show you. A couple weeks ago, it was at 99% chance, 99% chance that we were going to get a rate cut in September. Look at what it is today, 70%. 70%. That means that there is a 30% now before Powell speaks, and watch it after because it could go in either direction, like it could jump. 70% chance we're going to get cut, 30% chance that we're not going to get cut. What do you guys think? Can I ask the audience really quick to help me out? What do you think? Do you think we are, yes, going to get rate cuts, or no rate cuts coming in September? What do you guys think? Drop it in the chat. I just want to see. Let's see what you got. What's the thought? What's the crowd sentiment here? I mean, it's tricky. It really is. Predictions are all over the place, man. Like I've seen people who are thinking we're going to get 2 to 3. I've been seeing people who say we're going to get 0, no cuts today. No cuts in September, no cuts the rest of this year. I think a big factor, yes, is going to be whether Powell kind of loosens up on his hawkishness today. That's a big factor. But you know what else is a big factor? The jobs report. I don't know how many more jobs reports the Fed can look at with a straight face and say, let's just let it keep going, right? So, I mean, this is where you start getting into, look at the NFP report. The NFP report, they revised that number from 147,000 jobs reported on July 3rd for the month of June. They revised it to 14,000. What is going on? Like, first of all, what is the BLS doing with their jobs report? Like, it is so jumpy. Maybe it's manipulated. Who knows? Who really cares? The market trades off of this data. It moves the market. But here's the thing. They revised that number down by over 125,000 jobs. like what is going on, first of all. Second of all, the bigger picture, just like generally, what's the direction of this? It's moving lower. Hiring is slowing. At what point does the Fed have to just say, okay, yeah, we need to, we are restrictive enough that it's materially slowing the jobs market. We're not in a crisis, but you can get yourself into a crisis if you wait too long to cut rates. So this is where things are just hard, right? You got inflation over here, you got jobs weakening over here. What do? Trust me, I do not envy Powell's job, especially with Trump, threatening to fire you every other second. Like, I'm pretty sure Trump is just sitting there typing all day long, fire this guy, fire this guy. And, to be honest, to be completely fair to Powell, politicians always want you to cut rates. Doesn't matter if they're Republican or Democrat, doesn't matter. They all want you to cut rates because it makes them look good. Everybody wants to look good as the president. It's just a little bit of the game that gets played in Washington, right? If you're the president, you want them to cut rates. If you're the Fed, you're like, we got to look at everything. And no matter what you do, the Fed gets, no matter what you do, the chairman is a hated role. Because I saw something, I think it's Alan Greenspan that said this. He's a past Fed official. I think that he said that the Fed chairman role was really just created to give presidents a scapegoat to blame on things. And I think it's really true. It's sort of like this role where if the economy goes really well, the president can say, look what we did. And if the economy does really bad, they can say, the Fed sucks. So I don't know. It's that's what I would do if I was the president. I'd use it as my defense mechanism. But I will never run for president because that sounds like an insane role. Same with this, the Powell, or his role. Those are just insane. Anyways, stock market is bouncing a little bit ahead of the event. We'll see what happens here. You can see the stock market dropped yesterday. Overnight, and then bounced back sharply here. Nothing huge though. Volatility still remains really at bay. If there's going to be a move today, it is probably going to be around the 10 a.m. meeting. So we'll see what that brings. To help me get ready for this, first of all, I just want to reiterate, I said this earlier, the economic data reports that I've just been discussing and using for analysis, you can access these too now, some of them for completely free. If you're interested in getting access to the free demo version of the Edge Finder that is now available, we've just launched it this week. The link is being dropped in the chat for you right now. Fill out this form, and that will send a copy of the Edge Finder free demo version directly to your email. So send this or click this form, fill that out if you want to start exploring and playing around with the Edge Finder's free version and features now available. It is a limited version, but it gives you a chance to explore the tool and just check out some of the features in case you choose to purchase the full copy in the future. If you are an aspiring fundamental analyst, I think this is a must-have tool. Obviously, I'm a little bit biased because, I'm the guy who helped design it. But of course, I think it is genuinely a really important tool. Last thing I want to say on sentiment going into this, there's a little bit of fear building. You can see puts getting bought here aggressively, but not super insanely. It's still kind of in the middle ground. So we'll see. But if we take a look at, we did get AAII investor sentiment. Look at this. Crowd's still kind of scared. Interesting. Investor sentiment survey still bearish. It's been bearish for some time. Crowd's still a little scared of this market. Take a look at the Bitcoin to gold ratio trending lower now. That may be a signal that you may be entering more of a risk off type environment. Bitcoin underperforming gold here. Something to think about. Definitely some interesting stuff. Commitment of traders data, last thing I'll say, and then we're going to be joined by extra hot Forex's very own Kenzo. I'm excited to hear from him. Quick look at the S&P 500. Look at this. Institutions continue to be selling, which is interesting. Very interesting. Selling SPX futures. Take a look at gold, continued buying on gold. Thought that was kind of interesting. Sort of supports the narrative we've been discussing here. So we'll keep an eye. Here's the US dollar continuing to be sold. Really interesting. Really interesting. So again, check out the Edge Finder free demo version if you'd like to explore our tools. If you want to start tracking institutions, start tracking economic data, sentiment tools, all sorts of stuff to go beyond just looking at technical charts, I highly, highly, highly recommend you do so. There is more to trading than just looking at candles, in my personal opinion. Okay, in just a second, we're going to play a quick ad break, and then we've got extra hot Forex's very own Kenzo joining the stream here to discuss ahead of the big Fed meeting. Stay tuned. We'll be right back after this. If you're someone watching the show right now and you're outside of the US looking for a better brokerage, listen up. I wanted to take a moment to mention today's live stream supporter, Vantage. Vantage allows traders outside of the United States to trade CFDs. You can trade everything from commodities like gold, you can trade US indices or global indices, and you can even trade FX all under one brokerage, and you can connect to MetaTrader 4 and trade directly on tradingview.com. Not to mention, they also have a really good sign up bonus going on right now. So we'll drop the link to that down below in the chat as well as in the description of this live stream. Check out Vantage. Now back to the show. Hey, Kenzo, good to see you, man.
Good, thanks, man. And how are you?
I'm good. It's good to have you back on the show, and especially with such a critical countdown here to the Powell speech. Kenzo, we talk a lot about the fundamentals together. We've done it for some time, usually every Friday. So it's nice to have you back on. And I'm just curious here. We've got just about 25 minutes to go here before we hear from Powell. Wanted to get your take on what we should be looking for. Do you think that Powell is going to signal rate cuts? Do you think that there is evidence to suggest that he should or shouldn't? What are your thoughts? What do you think he's going to do?
Yeah, I think for the past few events that we already received, they were very cool, not really on the positive side, which is actually good for the rate cuts. So I'm expecting some positive news from him. And if maybe we had the last speech, I think it was May or March, he said we are going to expect maybe 2 rate cuts. I think maybe he might continue like that. But at the moment, tariffs left and right, and the stock market is now actually this week never actually even tried to push the upside, which is actually good. A few NFPs here and there, CPI was also not really that aggressively positive, which is also good. So I think it's a good time to signal some rate cuts.
If he's going to do it, right, it would be today. Like, because we do not hear again from Powell this month, the next time we're going to have kind of that big decision is the Fed day. So if the Fed is going to cut in September, I think this is what makes today a potentially very volatile event. If there is expected to be rate cuts in September, we should probably hear from Powell today that there, is some room to be dovish. The Fed has been very, for the most part, to their credit, been very transparent about what their plans are. For the most part, if they see, rate cuts or rate hikes or rate holds, they've signaled that pretty consistently. In fact, for the last, multiple years, we've had I don't think we've had any very big surprising hikes, cuts, or holds. Like almost always the market knows what it's going to do, what the Fed is going to do before they do it. So that would tell me that if this is the precursor to the next big Fed meeting, that we should hear one way or the other from Powell. He's likely going to give us something where they're feeling like inflation is too big of a problem and they're not going to cut rates in September, or that they don't necessarily have a decision made. I think what he'll always say, we don't necessarily have a decision made on September, but the bigger question would be, does he signal like our bigger risk right now is inflation? If he says that there are bigger risk to the mandate right now between jobs data and inflation, if he leans heavy on inflation is the bigger problem right now, the market could say, okay, well, inflation's on the rise, so they're thinking they might not cut rates in September. So it's really a tricky and really important event today.
Yeah, I think, but if you checked, remember, we are now on the second half, and now we just left with few months before year end. So which means one way or another, he might signal maybe one rate cut or something like
Mm,
that. As before, he said he's going to, maybe we're going to have two rate cuts. Even though he might not really be that specific. Remember, Trump tried to push him to cut the rate. So maybe he's not going to fall for that, not to seems to be like submitting to Trump, but at the
mm,
same time, investors want to know if maybe there is a possibility of rate cuts, which I think is quite possible. And for if we check maybe 3 months of economic events, I think they were agreeing. I think those events they were all cooling off, which is a good thing.
mm,
And yeah, I think we've been on a little bit higher rates, obviously, one way or another. The thing I think maybe the only thing that I think is still very playing around that we're still not really sure about is tariffs,
mm,
and they make prices to go up. Obviously inflation will slowly go up. So that is something that we don't really want, and it's already happening, unfortunately. I think that is something that will delay rate cuts, but one way or another, maybe they might try, maybe one that will be much better. But at the moment, I feel like they have a green light. Maybe once, maybe once, I think it's going to be much better.
mm. Yeah, it's really going to be interesting because as you mentioned earlier this year, they signaled for, I believe, 2 cuts that was in the dot plot earlier
Mm,
this year. So the question becomes, if you're going to cut twice, if you're going to stick to that plan,
mm.
we probably need one in September and one in December, or one in September,
Yeah.
one in November, something of that dynamic. I think it's really unlikely you get 3 unless something seriously drastic happens. I think
Mm,
2 is really up for question. I think 1 is kind of expected. So that's kind
mm.
of the consensus of the market right now when you look at like the Fed Watch tool. What do you think about gold and silver here, Kenzo? Do you think that there is they've been really choppy. Gold has been really range bound. Do you have any trades on gold? Are you looking for trades on gold, or are you skipping it right now?
At the moment, I'm still waiting. I was expecting it to push a little bit higher,
Mm,
but you can check for a few weeks now, it's been ranging. Unless if it goes a little bit lower, then I
mm,
think around the support there, it's where maybe I can look for another position or maybe another buy. But when we check fundamentally, Trump, Putin, Zelensky, all that, I think the signal there it's towards ceasefire, which is actually good news.
mm.
Even though it's not like happening like now, but I see that the aggressiveness it's starting to slow down, which is good, but which is not really good for gold. So that's why we don't really see any positive momentum from gold. So any update from Trump, Zelensky, or Ukraine, Russia, I think that resistant area is going to be tough to break. I think we might end up seeing a sort of a downtrend. At the moment, I don't really see any push to the upside.
Yeah, I think it, especially if you get something that is surprisingly hawkish today, that would
Mm,
likely send gold lower here. That in combination with what you mentioned, geopolitically, we've had, discussions happening between the parties involved in the Eastern Europe conflict. So that there is that as long as discussions are being had, that is generally perceived as positive. If
mm,
discussions are ceased, they're not happening, that is perceived as more negative because then things may not be
mm,
progressing in the right direction. So I think from the eyes of the market, um, you know geopolitically, things seem to be in a much better situation than we were months ago, where we had stuff going on in Israel, and we also had, of course, um, trade war dynamics that were really uncertain. So we've had a little bit of a shift in that geopolitical tension. So that would be more of a bearish thing for gold prices. But what has been a bullish thing, in my opinion, has been softening labor data, expectations of a
mm,
potential cut to help a cooling economy. Those things I think actually could support gold bullishness. So I'm kind of in the same camp as you. I like the idea of a buy around gold if we were to get a larger pullback or sell off. I also like the idea of a breakout retest opportunity on gold, but where we currently sit, it's just
mm.
been so quiet, so range bound. There's just not been very much movement to capitalize on. So, and I guess, what about oil for you, right? So we've talked about gold, oil prices kind of moved by some of those same geopolitical factors. What are your thoughts here? Are you more on the bearish side of oil based on, ceasefire sort of things?
Yeah, I think if you check the movement there, the sell-off after
Hmm.
Trump and Putin were in a meeting, that continues to cool off. If you go on a bigger time frame, maybe try daily or maybe make it smaller, and on top of there, just squeeze
Hmm.
it another one more time. No, just make it
Yep.
smaller one more time.
Yep.
Mm, yeah, make it smaller. Not don't zoom it closer.
Like lower time frame.
No, a bigger time frame, but I just want to see a longer chart, like maybe and say years, something like that.
Gotcha.
If you draw the resistance line there, you can see that that bearish momentum is still actually playing around, so it's still there.
Hmm.
So that's why I've buying there. If you go on a small time frame, yes, it seems like maybe there was a smaller support there, but if you check on a bigger time frame, it still looks good to say we are still on a downtrend. That's why slowly we can see that it's struggling to go higher. It went up the time I think it's Iran and Israel. They were going head to head. It
Yep.
pushed up, but after that, we started to see the market selling off. So I still believe that we will see some sell-offs here and there because Trump seems like he's not gonna place some tariff on on Russian oil. And I saw India and Russia they still tightening their their relationship, especially when it comes to buying oil, Russian oil, also China. So which means it's not really going to be a big deal if maybe there is any other tariff against Russia that went a little bit lower, or there's no much of a risk at the moment.
Sure. Yeah, no, I love the breakdown there. And again, the longer term downtrend in oil has been persistent for some time. And we'll have to keep an eye on that, and especially the geopolitical stuff. Kenzo, we've got markets moving a little bit higher here ahead of the meeting. We've got, or the speech, we've got about 15 minutes to go until that begins. We also have the VIX a little bit lower here so far today. Dow Jones is actually making a run for the highs here currently. Take a look at US 30, pushing upwards today. So we'll see how everything plays out. The Russell 2000 also up on the day. NASDAQ is up. These are sort of just bounce backs from yesterday's sell-off. Everything is still
Yeah,
kind of
which is good.
remaining. Go ahead. Can you hear me, Kenzo? You might have lost connection. Looks like we might have lost him. All good if he needs to maybe come back. Let's try and see. He's trying. All good if we lose him. Maybe we can you hear us now, Kenzo?
Yes, I can hear you. I think maybe my network is a little bit slower,
Okay,
but I
no
can
worries.
hear you.
What were you going to say? Looks like we might be having a little bit of delays. We might have to bring Kenzo back at a later point, or if we don't hear from him, if we're sorting that out just on the backside, I just want to make sure that we really give anybody who wants to check out Kenzo a chance to check out his YouTube channel. We'll drop the link here. There's Kenzo. Can you hear us now?
Yeah, I can hear you a little bit. I think my network is a bit choppy.
Gotcha. No worries. What were your thoughts on the S&P and the NASDAQ? You were about to say something? Okay, all good. We're gonna just call it good. I don't want to, keep trying to sort it out on his side. But like I said, if you want to check out Extra Hot Forex, Kenzo, if you can hear me, we'll have you back next time. I appreciate all of your commentary. And for anybody who wants to check out Kenzo's YouTube channel, we've got the link here. We just dropped it in the chat. Make sure to go subscribe to his YouTube channel. Again, great content, high quality stuff. And even if we don't hear back from him today, we will definitely hear back from him in the future. We have him on regularly. He's a great fundamental analyst, and always appreciate his commentary. So thanks to Kenzo for joining the stream. And let's keep going. We've got just about here, guys. We got about 12, 13 minutes to go before we hear from the big man, JP. I said this earlier. I asked what the audience is feeling. We've got a lot of people in here now, 770 people watching between all the different places we are streaming. Curious to hear you guys' thoughts. What do you think about gold? Is gold going to make a move here today? What do you guys think? Gold bullish, gold bearish? What's the crowd sentiment? I thought that was kind of an interesting take from Kenzo, a little bit more dovish than I am. And that's what we do with these streams. I like hearing from people who have a different opinion to hear what their thoughts are. Kenzo kind of thinking that the Fed is going to actually signal some cuts. Curious what you guys think. Gold, for example, would be bullish on the idea of more rate cuts and would likely be bearish on signals of less rate cuts or no rate cuts, right? Those things would be negative for metals and also for stocks. So I'm curious what you guys think. Bullish or bearish on gold in the chat. Let me know. I lean a little bit more towards bullish on a bigger picture, but technicals here for gold just are so ugly for me. I just really can't get a strong, convicted buy setup on gold. Maybe if I was like more longer term, but even in the longer term perspective, I'd be much more interested in longer term buys on a larger pullback in gold. Pull back to 3,000, pull back into the 2,000s would be a little bit more interesting on a longer term perspective. From a trading perspective, I like the idea of a possible bounce around 32.60, breakout retest around 34.20. I've said this a million times on my channel here recently, but I'm still just waiting for movements to happen. Even if we got something like a break here, like if we got a move here, that would be great. If I was still very bullish, I could possibly look for that trade depending on what price action looks like on like the 4 hour, but the daily chart's just keeping me from really having any decisive directional bias. S&P 500 making a push back up. Let's see, we've got a little bit of support here, that past area of resistance. We'll see if that, at the end of the day, it comes down to what Powell says. Powell's got to cut or else he'll get a lot of backlash. That is true. Question is, does he care? Right? Trump's been badgering him to cut rates. We'll see if he kind of has any comments on that. I think he will completely avoid that conversation. If anybody were to, anytime people ask him about, hey, what are your thoughts on the president, this, that, and the other, he never answers that. So I think that's unlikely that we'll get too much of a commentary. Some people have made the argument that maybe he'll take this as an opportunity to kind of stick it to the president, with the idea that, we're not just going to cut rates just because you want it. The Fed should be independent, which I do actually agree that the Fed should be independent. Most people, that's a bipartisan thing, that when the Fed was created, it's supposed to be independent. However, you could argue, and this is what people will argue, is that, oh, well, Powell favors one side over the other, and, we're human, so we have biases and all this and that. But, and you could argue that, a 50-point rate cut right before an election looked a little odd. So, I see both sides to some extent. Anyways, we'll see. S&P 500 is seemingly finding a little bit of support here around the 63.60 level. If you're a bear today, I would look for price action breaks below that level. Taking out today's lows could be a signal that we have more room to pull back. And I think the clear and obvious level here for most of the bulls would be a break through those highs to fresh blue sky territory. Taking a look at currencies here with 9 minutes to go. Also, James or Chandler, if actually, you know what? I might, if one of you guys could send me the link, I think I'd like to pull up the stream on my side just so I can pull up a chart next to it. That's kind of the, if one of you guys has the link, if you could just Discord message it to me, that would be awesome. Dollar index is staying firm here ahead of the speech. You do have a little bit of support here. little bit of support here that seems to be forming on the dollar index. Possibly a little bit of a higher low formation taking place. You've got bullish support below. This level has been clearly a level of resistance here recently. So we are kind of stuck in no man's land. Let's see what happens today with the dollar index. If you get something from Powell that is a lot more hawkish, where's the dollar going to go? Boom, could break through the highs. If Powell comes in surprisingly dovish, dollar could absolutely rinse lower. Because right now the market is kind of expecting hawkishness. So if you got surprising dovishness, the bigger move potential, big move down for the dollar. Again, I don't know what Powell's going to say with this with certainty. My educated guess, or basically my best guess of what I think he's going to say is I think he's going to come in a little bit hawkish and signal maybe some room for a cut this year. I think that's what he's going to say. I think I could be wrong. You know, the surprise, there's always the potential. This is how markets work. Markets expect something. There's the potential for a shock. The shock today would be either we're not like in a place where we see rate cuts coming, or the opposite extreme. We think the labor market has shown significant signs that it's cooling and it's time to cut rates. That would be, those are where you get big moves, right? If you hear from Powell and he says like, we're going to keep watching the data and, you know, but again, Jackson Hole, historically a time where the Fed is a little bit more vocal on what they plan to do, that's where you have the potential for sharper moves. But my best guess is I think he's going to lean a little bit hawkish. If I'm wrong, I'm wrong. And it wouldn't be the first or last time that I'm going to be wrong sometimes. That's why trading is hard. It's hard to predict this stuff perfectly. But that's my best guess. My best guess is I think Powell will come out a little hawkish, and he will point to inflation and the producer price index numbers, the inflationary data that we are seeing that is showing some signs of stickiness. And I think he will lean more towards concerns around inflation than he will lean towards jobs data. We'll see. Do I think the Fed should cut rates? I think the Fed should cut once, at least, maybe twice. The labor data is showing signs that it's weakening. In my view, making a big prediction of what's going to happen with inflation is also a potentially very risky thing to do. A couple of years ago, Powell was all about saying, you know, inflation's going to be transitory. And then it just kept going and going and going. This time he might make the opposite end mistake where he says inflation could be coming down the pipeline and keep saying that and let the jobs data weaken. To me, that is a risky thing to play with. So I think the Fed should cut rates maybe twice this year, and just keep an eye on inflation. But the CPI is at 2.7. Fed target rate's 4.5. So I actually think that the Fed should cut rates, but Powell has been very hawkish, and there is a case to be made that inflation could stay sticky. So I think he might lean into that. And so that's my thoughts. Sometimes you have to trade not necessarily just what you think should happen, but you have to trade based on what you see. And what I see is Powell has been pretty hawkish. So we'll see if we get a surprise, a shock. I've got the stream at the ready here. I will pull that up when it gets closer in. Let me just pull that up on my second. Well, pull it up right here. I'm just going to pull this up on my second monitor just so I can, let's see, pull this up. Jackson Hole Symposium, Federal Reserve Chair Jerome Powell remarks. I'm also going to go ahead and prep my screen by stopping it and sharing it so that you can hear my audio. So give me just a second here. Share system audio. Okay, so I will pull up the stream once we get a little closer and have that at the ready, so that you guys can also hear the stream. What I'm also going to do, actually, let's just go ahead and set this up. So I want to put on one side of my screen, I want to do charts. And then on the other side, I want to have the speech. So here we go. We've got that. Let's keep that to a minimum size. I think that's okay. And then we'll set up our charts so we can just keep an eye on what is happening in the markets. This is pretty cool, right? We got everything set up to watch the markets freak out. So let's just make this a little bit bigger just so we can see Powell and his pretty face. Pull up chart here. And I've got, let me see, do I want to do more than one? I am probably going to go on mute and just take some notes while I listen. You guys, of course, feel free. Stick around, listen with me, and I will periodically keep an eye on charts, just flipping through stuff. What I'll probably also do is I'm just going to, where's my my layout? I'm going to put two charts up here. On this second chart, I'm going to put gold, just because I know you gold junkies can't help yourself. So I got S&P up top, got gold on the low here. I'm going to go for a time frame switch as well. Where's my time frame? There it is. Put 15-minute charts, just so we can keep an eye on the intraday here and what we're working with, man. This is it. Anybody else get really sweaty just now? I'm just kidding. Just a word to the wise. I've done this for a long time. If you are like heavily positioned going into an event like this, you should never be heavily positioned. It is just, that's how they get you. You know, the markets are a dangerous place if you have huge trades on. So please be careful. You could get some big volatility today. You could also get some fake outs in both directions. Whatever your thoughts are, be humble enough to recognize you could be wrong. And personally, I'm going into this event. I have trades on. I've several long positions on stocks. I have a couple currency pair trades, but I'm very low. I have very low risk on going into this event. I have a lot of cash sitting on the sidelines. I would love to see a dip in the markets. If the market keeps going, though, I've got covered calls and a lot of stocks I own. So we'll see. We've got gold making some kind of move here. Could we just do a double check just in case there's no other live streams showing it right now? Just in case, because we do have some movement happening. Is anybody else seeing it? Is there another live stream that we're missing? Dollar down, gold up, stocks up. You are seeing a move here. Something's happening. No feed from the Kansas City Fed. Are we missing something? Something must have gotten said or done. Stock's pushing here. I'm not, again, we're working on seeing if we can find any other streams or if Powell's talking. Okay, where are we at? What's going on? Fed's Harker, magnitude of a rate cut is less important than the signal. Interesting. With policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Yeah, look at gold here, guys. Gold is ripping here.
Has
There we
come
go.
down a great deal from its post-pandemic highs.
Let's hear this.
At the same time, the balance of risks appears to be shifting. In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework, as captured in the revised Statement on Longer-Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a makeup strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor helping keep longer term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
All right, there you have it. Can everybody hear me? Just make sure I'm coming through okay. Yeah, very, very interesting. I took several notes, and I'm definitely interested in discussing, sharing everything that we just got to see. Just a quick high-level view. Indices made a jump higher, up 1% for the S&P 500, time of recording. S&P or the Russell up 2.5%. Gold made a push, up about 0.7%. Silver is moving even cleaner. Actually, this looks really good. Oil prices. Hold on, I'm going to sneeze. Maybe a second one. Nope, I think I'm good. Yep. So oil prices moved a little bit. Look at Ethereum, man. Ethereum's up 8% off of that. Crazy move there. Dollar index, big push lower here. I want to get into what we saw here, and to help me with that, we are bringing in Marco, who's going to be commenting a little bit with us on what's going on. So we can just bring Marco right in, just talk a little bit about what we just heard from Powell, and see what he has to think. Marco, how's it going, man?
Hello, I'm doing well. How are you?
Doing good. It's good to have you on the show to help kind of guide us a little bit here of what we just got to see. I felt like it was a little bit surprisingly more dovish than expected. Would you agree?
Yeah, definitely. I think I at least did not expect this sort of a speech from Powell. I thought he was going to continue with the wait and see mode, and he's going to signal inflation, because that's also something I've been seeing on Financial Juice. Fed officials commenting on inflation, and the meeting minutes also signaling inflation as an issue. But I guess the last NFP kind of changed their opinion possibly, and Powell now has a pretty different stance than most of the other Fed meetings that he led before. So I think a cut is definitely going to happen in September, maybe even 2 cuts in 25.
Yeah, and to the point too about in terms of his tone, I guess. I noticed that he kind of reiterated a few times that he felt that policy is restrictive, has been restrictive. He specifically said modestly restrictive, which tells you that if he thinks that, okay, if labor data is starting to show some signs of cooling, and he also thinks that things are restrictive, which is something I've been talking about in a lot of my content. I've been talking about, if you think the rate is restrictive, that means that you have room to come down if need be. But also restrictive means that should also help with inflation. So if he thinks they're modestly, restrictive, I think that would suggest that he thinks there may be a little bit of room, which was at least my expectation for this was, I thought it was going to be more of a hawkish cut, where I would categorize this personally more as just a cut. Like he's signaling a cut, maybe not, 5 rate cuts the next year, but seemed like he signaled pretty clearly that there is room to bring the monetary policy rate down with the added risks. He also pointed out that the long run expectation for inflation seems in line, so they feel okay longer term about inflation, and that they've noticed some things in the labor market. So I thought it was a little bit more dovish than expected, and you did get a pop on a lot of markets.
Yeah, absolutely. And I think the latest environment with the Fed was so hard to forecast. It was such a change of tone between meetings and as the data was coming in. So with this last one, I think Powell really changed his approach, changed his whole tone. Where now he's more open to cuts, and you can see a definite reaction in the markets. I mean, it's quite a big push on the euro dollar, so the DXY going lower. I can quickly go through it. So euro dollar, nice big pop to the upside. The Nasdaq and the S&P having a very nice reaction. Gold also pushing higher, but not so much, kind of remaining in this flat range. But the DXY definitely also dropping lower. So I think this was kind of unexpected. I also found a poll that Brent Donnelly did, and it was a poll that was completed by 500 traders. And the results were that most traders believe Powell was going to be hawkish or neutral.
I saw that.
Very few people. Yeah, very few people actually thought he was going to be more dovish. So this was a big surprise. And if you had a bet that he was going to be dovish, you could have made quite a lot of percentage. Yeah, this is the poll. So basically, almost no one had a dovish response or a dovish forecast. That's why forecasting these things is so extremely hard, and it's much better to focus on the actual raw data than these speeches, which tend to be sometimes hawkish, sometimes dovish, sometimes it's a huge surprise. So we try to kind of connect all of the confluences and then build an overall bias. So that's what I would recommend to people, to not just focus on one speech, but actually assess all of the data and then make a decision.
Well said. Yeah, I definitely agree with you. I think it's really important, going into this, Powell pretty much said all of the things that we've been focused on heavily in our kind of fundamental analysis here recently. You have threats to the labor market. You also have stubborn inflation. But by the Fed's own accord, 4.5% compared to the 2.7% CPI is restrictive. So there is a little bit of room. And I think that is what we got kind of confirmation of, was that line of thinking is correct, that a cut this year still seems on the table. Actually, I was looking at the FedWatch tool, and we do have going out to December, right? So if we look at September, you've got a 91.5%. So cuts are back on the menu, it seems, for September. But then I went out to December, which is really the interesting thing, to see the end of this year. We actually have now probabilities for 2 cuts. So we have kind of confidently come from, we're currently sitting at 4.25 to 4.5%. So the probability of an unchanged interest rate by end of year is very low, less than 1%. The probability of 1 cut is actually low. The probability really leans 2 to even 3 cuts. So we're back on the, path to, okay, we have room to bring the interest rate down. And so, this number has jumped all over the place. We saw this number went from 99% to 80%. I saw it actually, I think it went lower than
70.
That. Yeah, it went to 70%.
Yesterday was 70 something. So
yeah,
pretty crazy.
So we went 99% to 70%, back to 92%. So probabilities jumping all over the place. There was, questions as to whether or not the Fed was going to cut. And to be fair, I also was like, hey, is he going to come out and swing on the hawkish side? So I think this was a pleasant surprise to markets to get confirmation that, okay, he's not uber, hawkish. He's not kind of going to take the extreme path and say, inflation is the only problem, which I think is the correct call. I mean, you have evidence of both sides showing struggle. And I liked the way actually that he outlined, what do they do in this circumstance? I don't know if you caught that, but he said, what is the Fed supposed to do? I thought that was a really important thing that he distinguished. And he basically said, we watch both, and we essentially adapt to whatever is the bigger problem. And with his acknowledgement that we are in a restrictive state, he also pointed out that there's room to kind of administer to both sides.
Yeah. From my research, if the Fed has to choose between saving employment or cutting inflation, they're going to focus on employment. So they're going to be more dovish than hawkish if they have to make the choice. That's at least from what I saw in my research. So that kind of follows with his speech today.
Yeah, because I think prices are so volatile. But one of the challenges to prices is that there's also external factors that would be thrown into that combination, like oil prices and supply constraints that can kind of just cause prices to temporarily move in extremities. But employment is a strong trend one way or the other. Like if employment data is really trending down, that's a hard trend to stop. And so with the Fed starting to pay attention to cooling jobs data, I think that's the right call. And I've been saying, I think you're on the same camp, like some cuts make sense. I don't think, Trump pounding the table and saying we need, 2% cuts right away. I think that's a little drastic, but the idea of getting some cuts makes a lot of sense.
Yeah, like gradual cuts. And I'm waiting for the tweet from Trump. Hopefully it's going to be positive. Hopefully he's happy with Powell for once. But basically, I know some traders even anticipated that Powell was going to have like a speech that is a slap in the face to Trump, just highlighting how inflation is rising and we need to remain in the wait-and-see approach, and signifying how it is important for the Fed to separate itself from the administration. And that would be an even bigger reaction to the markets, I think. But Powell now kind of following the story of the cuts, at least some gradual cuts, makes the markets more calm, creates more certainty as well for the markets. So I do like the story, and for me as a trader, for my current positions, this is good as well. One thing I don't like is that we did not get a pullback on the Nasdaq, at least not for now. So I was looking at these areas and I was seeing us pull back, and I was finally starting to maybe anticipate a retrace of, let's say, 6 or 7% to get in on some buy setups, but that is not yet happening. So we will see what will happen with that.
Yeah, I was going to ask you, like, positioning wise, where you're at and what you're thinking. Just to touch on the Nasdaq, I'm in the same camp. I've got a lot of stocks that are obviously up today. I think if I check my account, I'm up 1.2%. So I'm just shy of what the market's doing, which is largely attributed to the fact that I have a bunch of cash sitting on the sidelines in covered call positions. So I've capped a little bit the upside, but still a good day on the account for me. I think, though, that I still remain in the camp of I like the idea of indices continuing to move higher on a bigger theme, but I think patience will pay out in the end. For those of us who are trying to wait for pullbacks in markets, I don't think it's the wrong call. It feels like the wrong call when the market's jumping. Oh, I should have already been buying this dip, but I don't know. I feel like it's recency bias is really dangerous. Market's been going up, so it's got to keep going up, right? That's the thought process right before you do get some normal, healthy pullbacks. And if you are kind of like drastically rushing to buy every single down day, the challenge becomes when a normal, healthy pullback comes, you're going to be like, this is a crash, right? So you're going to like panic yourself, as opposed to just patiently waiting. And, it's one Fed commentary. You could very well have, movements in the next few days that continue to pull back. And I still think that the bigger picture is bullish, but that you may get some intra-trend bearish moves. So I'm holding out for pullbacks. I don't think there's a need to chase or make big drastic decisions off of this Fed meeting. Gold and silver, I'm happy to see some movement there. Do you have a silver trade on?
Silver, nice. I don't have a silver trade on. I'm looking for buy setups on gold and silver since they are getting a bullish reading on the edge finders. So on gold, I would like to get a breakout of this level of resistance right here. But silver actually just broke out of this swing high that I was looking at. So I may look for buy setups. Probably not today. It's Friday. So on Monday, I'll probably do some research and see if I can get in on a nice buy setup. I would also like for this daily candle to close above this level. So print a nice clean close and close above this swing high. I don't need to wait for a break of, let's say, this high level. So I'm happy to look for setups right now. I would just like for the daily candle to confirm the breakout and close with a nice clean close. And as far as the Nasdaq goes, I mean, as you mentioned, this is just one speech from Powell. We need to look at the all of the data points, let's say. And I do believe the retail is heavily long, while the institutions have been gradually selling, if I'm not mistaken. And also the euphoria is here. Everyone is buying stocks. Everyone thinks they're going to go higher. So this is, in my opinion, a very dangerous time to buy at the highs. But buying at a pullback, at a discount, I think could be very high probability. So I'm still in the same camp as you. I'm waiting for a pullback. I'm not going to just jump in blindly because Powell was kind of dovish. I will still wait for a better pullback. And also we need to see some more data points. We have NFP in September. We have CPI, PPI. So let's see what those 3 data points will tell us. And then we can start to assemble the puzzle. Is the jobs market really deteriorating? Is the inflation going up? We'll get more clarity then. So, yeah.
Yeah, no, I love the way you broke that down, and I'm feeling the same way on the metals. Silver actually looks just so much better to me than gold. Its chart just looks clean. It's got higher lows. It's breaking through resistance as we speak. Whereas gold is so choppy. I've been on this frustrating campaign. You have a lot of people. Obviously, everyone loves trading gold. It seems like I do too. But there are times where it's like, silver looks pretty dang good compared to gold. Like, it's actually trending. It's got some momentum, whereas gold has just been stuck. And there are times to be flexible and adjust. The dollar index is another one to watch here today, making a push through. But I'm like you, I don't necessarily need a break through the all-time highs to get into silver. Like, if we get a strong close here today, like if we make this move, pull back into this region, I think the risk to reward still looks pretty attractive there with a tight stop. So I might actually try that trade too. I'm watching silver on pullbacks. I am also looking for oil shorts on pullbacks too. So we'll see what comes out of it.
And I wanted to get your feedback on the gold to silver ratio. It has come down quite a bit, so I don't think there's a huge edge behind buying silver compared to gold, but there's still a bit of room to reach the equilibrium, let's say. So yeah, you can definitely see the chart has come down quite a bit from the highs.
Yeah, it is interesting. I love keeping an eye on it just because from a longer term perspective, I'm just going to.
I think we're back on my chart, so I think we need to switch. Yeah,
gotcha.
Okay, great. Cool.
Yeah, from like a long term perspective, this is just a 200-day moving average applied to the gold silver ratio. I'd agree with you. Like, it does look like we have a little bit more room, but not a ton of room. In terms of just like looking at a longer term, we could even go to the week. We're already on the weekly chart. So this is a 200 weekly moving average. So that's a long-term kind of average gold to silver ratio. So for the audience members who have not seen this or heard of this before, we are just crossing the price of gold versus the price of silver. And the one that's performing, if gold is outperforming, it's moving up. And if silver is outperforming, it's moving down. And so we've recently seen this kind of shift in momentum in favor of silver. Silver seems to be moving with more momentum than gold. Though they typically do move in the same direction, one can outpace the other. Like, you've got silver up almost 2% today, and gold's up 1%. So silver, to me, that's like, you could almost apply kind of a moving average to this one if you wanted to, like a shorter term moving average. Like, let's just do like a 20. Is this a 20? No, let's do a 20 like week moving average and just make it a different color. Let's make it yellow. Like, you can see like the trend of this, which is the favorited metal, can sometimes be interesting to keep an eye on. But yeah, really, really interesting stuff. I do think silver still looks attractive. I think both look attractive on a longer term basis. But yeah, I think recently, momentum wise, silver seems to have it where gold just does not as much. So we'll see. And of course, this is not some sort of like all hail, can't go any lower than this. It could certainly continue to trend maybe back down to these levels that we saw in May of 2024. So we'll see. But yeah, interesting to keep an eye on this chart for sure.
Yeah, I know we were very bullish on silver. I actually took a nice silver win when we were right at the top a couple of weeks ago when silver was kind of of lesser value than gold in relative terms. So that was a nice setup, definitely.
Yeah, I know you had a great trade on silver. It's actually one of my favorite things to trade. I really like silver. When it moves, it really moves so clean. Gold, of course, I love trading too when it's trending clean, but sometimes you get stuck in chop, and I think it's a disaster to sort of force trading into something that is not actually cooperating. So, yeah, we'll see. What about the dollar, Marco? What are your thoughts on the dollar? You've got euro dollar jumping here today, pound dollar jumping, dollar yen plummeting down 1%. Yields are soft today, obviously, with expectations of rate cuts. What are your thoughts on the dollar?
Yeah, sure. So I can bring up, I do have a euro dollar buy setup, which almost got taken out, and now it's back to running a little bit of profit. So this was an idea mostly from the edge finder with the bullishness for the euro and also the general weakness of the dollar, because if you look at the DXY, it's definitely in an overall downtrend. So the euro has become a bit softer lately, but with now this most recent speech from Powell, the dollar has just lost even more value. So it looks like this chart is going to continue going up for now. My game plan is to trail my stop loss on this position. So if I do not get stopped out, if this does continue going higher, I will just keep moving my stop loss below these lows. So that is the game plan for Euro USD. My general forecast for the DXY is, well, long term, I'm definitely bearish because technical analysis is so bearish on this chart, on this daily chart. Short term, I'm still a little bit careful. So I'm still a little bit careful. I need those 3 data points. So I need the NFP, PPI, CPI. I do think, as I mentioned, we are going to get rate cuts, but I'm just worried that maybe the rate cuts are already kind of priced in and that maybe we won't go as low as people think. Maybe some traders expect just a massive sell-off. I personally don't. I expect a little bit more weakness, but in the short term, I'm kind of more neutral than in the long term. I just need a bit more data. I think we're a bit flat here on this daily chart, and that's why I'm actually focusing on setups like the Euro GBP buy and the Euro CAD short as well, which I think I did get taken out here, but I still think it was a nice hedge against my positions. I did see it in the A1 Discord, and I thought it was a really good idea. You did the analysis, and I thought this was an awesome hedge for my euro dollar and euro GBP positions. So I thought this was definitely worth taking, but looks like the euro is gonna win in this short term. So as far as the other dollar pairs go, euro dollar is my absolute favorite. Pound USD looks to be a bit flat here, in my opinion, so I wouldn't really touch the pound. I do think the pound is weak. Fundamentally, I do think there's a possible case of stagflation, so meaning high inflation and also lower growth. If you look at the Edge Finder historical data, you'll see everything in black and white. So both the GBP are weak and the dollar kind of weak. Not the best for creating trends. Aussie US dollar is, in my opinion, a bit too flat here in this area, so I don't want to touch it. As far as the USD yen goes, again, both currencies are kind of on the weaker side. That's why the price action is really neutral, and I'm not really going to touch a currency pair where I don't have a clear bias. So if you want to trade Forex, if you want to be a trend trader, it's always good to have one currency that is super strong and the other should be at least a little bit weak, preferably very weak. So euro dollar favorite pick to go higher. Other than that, I'm waiting for more data.
Fair enough. Yeah, and just following up with what you're saying about looking at some of the suggestions of the Edge Finder right now, the data points, euro dollar did pop back in as a bullish setup here. So a little bit of momentum here today, changing that score to be a little bit more bullish. Thought that was interesting. But of course, silver and gold have been kind of the proxy DXY short trades with strong economic data, weak economic data for the US dollar, suggesting some room for gold and silver to do okay here. Yeah, I would agree. I mean, also not to mention you've got dollar Swiss and dollar yen both getting very, very strong scores here to the downside, at least for now. So we'll see. But, definitely some dovishness from Powell adds into the equation of dollar bearishness, and we'll see what it comes next with. I do think that in general, when it comes to indices, I'm way more on the, cautious at these levels. You're back to all-time highs. As you mentioned, if you're in some of these great runners today, I think the best thing I'm going to be doing on some of my trades is trailing stops, or in my case with options, I like to sell covered calls. So I'll probably sell some fresh covered calls in some of my stocks, as well as, just kind of stay defensive, stay cash heavy, because I do think that, you are still stretched. You're still high valuations for companies. And I guess the next big catalyst for those who watch indices is actually NVIDIA. Later next week, we have NVIDIA earnings, which could be very market moving as kind of the AI trade is built around it. And that's been a huge precursor to this rally. So that will certainly be an important thing to watch going into next week. Marco, anything else? Any other ideas that you're watching right now?
Yeah, I just wanted to mention, I also found a chart that represents the volatility of the S&P, and they did historical analysis on different events, and they found that the Jackson Hole meeting can be the most volatile, NVIDIA earnings second most volatile, and then you have NFP, and then you have the actual Fed meeting. So as you mentioned, the NVIDIA earnings could be, you said NVIDIA earnings are next week, or?
It's next week, yeah. I think it's the 28th.
Nice, cool. So that could be very volatile for the S&P 500 and the Nasdaq. Other than that, I think we covered most of it. As far as the DAX goes, for example, I'm looking for a breakout out of these highs. Then I would consider a buy setup. I do think actually that a buy setup on the DAX could be an even better play than on the Nasdaq at these current levels. So I would even prefer to get in on a buy setup. On the DAX, I would just need to get a breakout out of these levels, because right now it's looking the same as gold, which is just kind of no man's area. And if you want to get chopped, if you want to take a lot of losses, then go ahead and take a position. But for me, I need a breakout.
Yep, fair enough. Love it. Marco, thanks very much for joining us here, as always, with the streams and commentary. And before you go, let me just remind everybody, if you enjoyed Marco's commentary, take a second to go subscribe to his YouTube channel. It's totally free value that he's got going on over there. And I highly, highly recommend you add it to your subscriptions on YouTube or x.com, wherever you're watching. Make sure to find him there, Marco's Trading Journey. Marco, thanks so much for coming on and for sharing your thoughts here post Fed meeting.
No worries. See you.
See you, Marco. All right, guys. Final thoughts here before we end stream. Just to recap, we have S&P 500 up about 1.5%. Nice pop for stocks. 1.7 for the NASDAQ. You've got 1.8, interestingly enough, for the Dow Jones, and 3.6 for the Russell, making a substantial push higher as expectations for rate cuts are back on the menu. You've got the DAX up 0.5%, the Nikkei up 0.6%. Chinese stocks actually making a push. VIX gets absolutely crushed. I have a long call vertical, but fortunately, this is a weird one because it's a hedge in my account. So if it doesn't work out, it doesn't work out. Although I still have until November, like the call options are out till November. So they are longer dated. And if you do get a pop, those could still come back into profit. But it's one of those things. If you're really long the VIX, but you also have a lot of stocks, you kind of hope it doesn't work out because it's a hedge, right? Like if it doesn't work out and stocks are moving higher, it's perfectly fine. VIX trade back in the red here for me, but it is, like I said, it's very small. I'm up. I can check again here, see what we're at for the day. Up 1.32%. So I am just slightly under the S&P 500's return here today, which is perfectly fine given my kind of defensive posture. Big part of that is you've got Tesla moving up 5% here today, which is fantastic, as I do have a good size position in Tesla. So that's kind of carrying my account today. Anyways, gold up 1.1%. And look at silver here. Silver looks real clean. That's probably a setup for me if I can get a pullback here. And I'll keep you guys posted inside of our signals room if you're a part of our VIP service. By the way, the signals room features Marco and myself. So the guy who was just on here, we both trade inside of our signals room. If that's something that you're interested in, let's do something fun. Today, if you send us a direct message on our website, we'll get you a huge discount off of our VIP signals group. You can either pay once for lifetime access or you can pay for the monthly option. Both are available on our website. We'll drop a link here in the chat to where you can speak directly to our support team if you want to get our trades sent directly to your phone or to your desktop. Every time we take a position, it notifies you. So if you've enjoyed our commentary, if you want to trade with us, join our chat rooms, join the coaching webinars that we do inside of the group. All of that stuff and more, make sure to check out by clicking this link here, our VIP group. Send us a direct message. Let us know you're watching the stream, and we'll get you some huge discounts off of any of our memberships. So there you go. Last thing, and this is a free plug here. If you want to check out the Edge Finder, which is the tool that we use to scan markets, we'll drop another link here to where you can sign up for the free demo version of the Edge Finder, which is now available. We have a free version available on our website. Click this link here to fill out that form and get access to that right away, sent directly to your email. Thank you guys for tuning in to today's stream. Have a great rest of your day, and we'll see you next time.
Thanks for watching today's show. Remember to subscribe if you're new and to turn on post notifications so you don't miss the next one. If you're looking for more free trading content, consider joining our Telegram channel, linked in the description down below, or find free courses, prop firm discounts, and broker sign-up perks on our website a1trading.com. That's all for today. We'll see you back tomorrow.